Hey everybody, it's Erik Torenberg, co-founder, partner of Village Global, a network-driven venture firm. And this is Venture Stories, a podcast covering topics relating to tech and business with world-leading experts. Hey everybody, welcome to another episode of Venture Stories by Village Global. I'm here today with two very special guests, Phin Barnes and Brett Berson of First Round Capital, dear friends of the firm. Guys, welcome to the podcast.
Great to be here. Thanks, Erik.
So Phin, to put you on the spot, what would you say is Brett Berson's superpower?
I would say two things, pace of execution and creativity driven by a deep understanding of the customer.
Yeah. And the customer here is the founder. Not the LP.
No, not the LP. LP is the shareholder.
Yes.
The founder is the customer.
So First Round has pioneered a lot of, what do they call it? Community as platform, a lot of stuff about just how do you serve value to the customer. I'm curious, how you think that this has evolved at First Round over time. So Brett, you've been there, what, a decade?
11 years.
Over a decade. Why don't you trace a little bit about how the philosophy of value add to the founder has evolved, and also just over time, what has added the value? Have founders' needs changed in the last decade, and how have you, as a firm, evolved to meet those needs?
Yeah, so I think if you go back, the First Round's about 15 years old. I think the firm was sort of founded around essentially sort of an arbitrage opportunity, where if you look at early stage venture 15 years ago, you could raise a few $100,000 or maybe $4 or $5 million, which would be considered a Series A at the time. And there wasn't institutions sort of occupying that sort of space that existed in between. And at the same time, this is sort of, all this stuff is, I think, somewhat obvious sort of in retrospect, but you had a number of trends that were sort of happening, right? The collapsing cost of creating a startup. You have so many of these new levels of abstraction. So you went from rolling your own servers to leveraging AWS. You had cloud and mobile, which made a whole new generation of companies very capital efficient to build. And so you had a ton of things that meant for $1 million or $2 million, you could actually get a lot done. And at the time, there wasn't sort of what we consider seed, pre-seed. The entire category didn't exist. So the firm was sort of started with the insight that, hey, what if we created a real institution sort of in this category? We think there's an unmet need, and we want to sort of close the gap there. And so the first handful of years of the firm was sort of organized around that insight. I think as sort of the firm kind of started to execute, a couple things we realized that the first sort of when I joined, and Phin and I joined actually as an interns in 2008.
Wow.
Which is kind of crazy.
Intern to GP.
One of the things that we started to talk a lot about, and I think Josh was really the driving force behind this, was the insight that venture is fundamentally an anti-network effects business, right? That most of the value that's delivered as a venture investor exists in sort of one-on-one interactions between the partner and the individual. And so the more that you invest, your time gets divided up, and so you're less valuable to each individual company. So I started to spend a lot of time thinking about, okay, well, how do you take an anti-network effects business and make it into more of a network effects business where as you invest in more companies, the value to each member of that community can actually grow? And that's when we started to sort of pull on threads of getting people together. And so one example was we had CEO summits, which I think most firms now have a way to bring everyone together every year. But at the time, it sort of wasn't a thing that in 2007 and 2008, a lot of people were doing. So we bring all of our founders together every year for all sorts of opportunities for learning and relationship building.
Hey, by the way, I see that as a general trend. It's almost like a gingerbread approach where you pioneer something, everyone else copies it, and now you're on to the next thing.
Well, I think a lot of people are inspired by some of the things that we've done, and we're just, I think, at a different point in the cycle. But it feels fundamentally differently today than it did 11 years ago. And I think a lot of our philosophy is to focus on something, do it well, and every year decide, is it something high impact for our customer? Can we do it better than anyone else? And are we providing something nobody else can provide? I think over time, when we see that other people are doing things, a lot of times we say, okay, somebody else is doing it. We don't need to do it anymore.
Right. Like what's an example of that?
So we used to sort of do a CEO summit. Right now we don't. And maybe we'll bring it back in the future, but we sort of started with a small CEO summit with like 50 people, and it scaled over 10 years to about 700 people at the SF Jazz Center. And we started to do that over time and started find ourselves saying we would talk to our customer, and they would say, I have 7 CEO summits to go to this year because every shareholder of mine is inviting me to a CEO summit, which kind of started to seem quite quite crazy to us. And so we've been kind of changing that and reinventing it in a lot of ways. But that, I think that's like a very sort of good example of sort of that type of phenomenon.
I also think with that, sometimes it's stopping doing something, and other times it's really focusing on how it's different. Right. So I think we did CEO Summit and we saw the value of that. And then we said, well, who else is in the business that needs to be served in the same way? And then we had a CTO Summit. And then as we evolved the format, we went from the classic sort of TED style talk across the course of the day with some networking sessions to ultimately having much more unconferences with both CEOs and CTOs. And so I think we also did things where we opened it up to the whole community rather than just to CEOs of companies where we had invested in order just to get the best people in the room and to continue to build community that way. Yeah. And so I think there's both. Sometimes it's something where we say, this exists, therefore we don't need to provide it. Other times we say this exists in a certain format or a certain approach, and we can provide it in this different way. I think our approach to talent is that way. In terms of how I think people think about talent as sort of, we're going to have this approach of, here's someone who's going to be a recruiter for you. We're going to embed them in your company. They're going to deliver. And I think we've approached that in a pretty different way in terms of saying we're going to think through the process of recruiting, the process of building a pipeline, funnel, job descriptions, all these things, and support the company as they do that in order to deliver those first hires.
How have your customers' needs changed? 2010, 2015, we're almost at 2020. How have you seen their needs evolve?
One thing that we've noticed is that needs of founders and companies are all over the map. And I think that, if you survey founders, they'll generally say, I either want customer introductions, talent, or follow-on capital, and that's really all I want. But I think when you really start to get together with someone and listen to what's going on in their business, I think there's like 17 different things that people want at varying points of time. And I think one of the reasons why we've chosen to really create a whole suite of different experiences, products, services, and quite a large team, given we still are true Series seed investors where we're writing $1 or $2 million checks or sort of what have you. And so I think what we found is actually that if you're a first-time founder, you're a second-time founder. If you're building a B2B company versus a B2C company. If you're building a transactional sale go-to-market enterprise software company versus a very complex enterprise sort of product or enterprise sale that takes a year versus a week. Each one of these different things, depending on where you are in the life cycle, whatever sort of top of mind for the founder or their team is entirely different. And so I think one of the things that's been most interesting is that we're always asking ourselves, okay, well, what does the customer want? And can we get rid of things? Because we'd like to focus on just 3 things and not 30 things. Right. I think the challenge is that everybody wants different things. And so I don't think that there's a singular, if you just help me raise my next round, or I just need to hire these 2 people, then you just kind of have it all solved. And so I'm not sure it's easy to sort of sum up, nor do I think in the last 5 or 7 years, like the fundamental needs of the customer has changed. The thing that's sort of the through line of it all is that I really subscribe to the idea that most problems are people problems. And I was talking with a friend about this, and who's also a founder of a first round company. And I think what you realize is the more time that you spend with founders, most problems tend to boil down to the way in which 2 people connect or interface with one another, getting rid of someone on the team or adding someone on the team. And so I think that, that's sort of the thing that has stayed the same over the last 10 years. I know you spent a ton of time in terms of coaching founders sort of focusing on that stuff, Finn.
Yeah, no. So I think if you think about all the needs as being quite diverse and depending on stage and focus and size of team, et cetera, the thing that I think is consistent is, you might call it the founder's desire to win. Yeah. But I think if you really dig into what that is, it's the founder's desire to grow. Right. And it's not just growing their company, but it's growing as a person, helping become a better leader, a better solver of the problems facing their business, but also helping those that they hire and work with, as Brett was just talking about, with how they connect with people, helping their employees grow and helping their team get better and move faster. And when you think about, if all problems are people problems, if you can work with founders to bring out their best and to help them access the information and context that they need when they face any challenge in their business, and then be able to pull that together, look at it and say, because of all this information, this shared understanding of the problem I'm facing, how others have solved similar problems in the past, I believe the optimal thing for me and for my company is to do the following. Yep. And then to have a partner that can push them on those things to really have them go even 1 or 2 levels deeper. Totally. And further. I think that relationship that you build is something that I think, while the specific way you draw out someone's best is different per founder, that high level responsibility of a partner, and when you partner with someone, what you're taking on is the obligation to bring out their best in every single situation. And I think knowing that the sum total of that ability will lead to the best outcome for the company.
Totally. And what do you think, having done this, 11 years or so, what do you think is the unique expertise that you've generated relative to your other partners, some of whom have been doing it longer, or other investors, in the market? How do you think about how you approach things differently, or you're, work with that generalist for this, but work with me for this? And Brett, feel free to jump in as you see fit.
Yeah. So I think that there's, you could point to certain aspects of, whether it's operating experience or companies that I've worked with, I've certainly learned a ton. But I think that the fundamental thing that I bring to the table, that I bring to a founder, is believing that the best answer to any question facing the business lies within the founder, but also believing that they don't always know it. And so you have to help draw it out, and actually focusing on getting very, very good at that.
Do you see yourself as a psychologist? Or the job is psychologist?
In some ways, right? And it's a process of self-discovery for that founder in that moment. And it is 100% of the time, if I think I have the answer, that answer is wrong, right? But it's understanding when the founder can go further. And I think also thinking of them as a person versus the CEO of this company where you're an investor can really help open up an understanding of what they are driving towards, what motivates them, the people problems that they may be facing, the way they're thinking about their team, the expertise of that team, where are they hopeful, where do they have doubts, helping them run towards the problems rather than away, and putting everything. The other thing is just to put everything in context, right? Like these decisions are incredibly stressful and fraught, but at the same time, for the most part, these are not life or death decisions. And if you can give yourself a little bit of space and back up a little bit and think through the situation relative to your goals and aspirations, I think you can usually make a better decision. And so I think for me, the specific types of founders where I become a really good partner for them are the ones that have that perspective around their desire to grow as an individual, as well as their desire to build an enduring company that wins in a market. Yeah.
And so given that we've been talking about a lot of different types of founders, a lot of different types of needs depending on their company, how do you two, as a person building out this firm, think about where you focus, where you build your products? You could say, hey, we're going to double down for this type of founder. We're going to double down at this. It's going to be all about talent. We're going to have, a team of 10 talent people. But you seem to be dividing it up between different baskets. How do you prioritize what's most important to add value to and then think about delivering it?
I think it's sort of in 2 buckets. One is we kind of have this sort of idea of creating, sort of executing a barbell strategy. And so going back to sort of what we were talking about at the beginning, there's a lot of things that we do that we think actually get better the more people that are involved in it. So we build a lot of software that connects all the different members of our community. So if you're a product manager at a first round back company, you can learn from all sorts of other product
you have sort of internal Quora or something like that.
And it's kind of like that meets LinkedIn, so you can search all the other product managers.
Cool.
So we want to invest in a lot of those types of things that fundamentally get better as they get bigger. And then the other bucket of things is things that we think can have a huge positive impact on a company in a very small amount of time. And basically, over the last few years, what we've tried to do is edit away everything that exists in the center. And I think it's a little bit opposite, because I think most venture firms, everything they do is in the center, meaning it's in many ways not particularly scalable. And on the other end of the spectrum, not particularly impactful, because, take something like different ways that you approach recruiting, I think is very tricky. It can be hugely impactful, but takes tens and tens or hundreds of hours to have true impact. And a lot of times, if different approaches to sort of scaling things, it tends not to be that useful. But yet, so many firms spend so much time on recruiting because their customer asks for recruiting a lot. And so I think most things tend to fall into sort of that sort of center bucket. Like in some ways, a traditional CEO summit might even fall into that. It's kind of scalable, but not really. It's kind of impactful, but depending on how it's executed, not really. And so I think from when we think about the portfolio of things that we want to create for our customer, we're trying to push things on those two extremes at any given point in time. And so like one example is we have this program we call Experts in Residence, and it allows for people deep in a given domain to pair with a given company on a specific problem. And so one example is we have somebody that focuses on marketing and product marketing, go-to-market positioning. Her name's Ariel. We've worked together for years, and she's just astonishingly good. And basically what she does is she pairs with a founder over the course of a number of weeks, maybe an hour or two every week, to basically get a company's go-to-market positioning very sharp. So like, how are you describing the product? Who is the audience? Why is it different? Sort of all of this type of stuff. And what we found is that's kind of that magical thing where, somebody leaves 5 hours of work with the business, the way they're describing the business, like fundamentally moved forward. And it's just incredibly meaningful, but it's not like you need to spend 300 hours kind of doing that to kind of move the needle. And so a lot of the strategy in terms of where we invest is about pushing things to the edge. Another example is for a number of years, we've been building this thing out we call Pitch Assist, which prepares people for Series A capital raising. And maybe we spend, that whole program that lasts 4 to 6 weeks, anywhere in the low end of 20 to 50 hours with a given company. Now, in some ways, that's a lot, but in that case, you don't actually need to scale. You don't need to do that 600 times a year. Yeah. If you think about core companies raising a Series A at any given point in time, there's probably like 1 or 2. And in that case, you can have this enormously positive impact because, right, if somebody is able to get a better partner for their business at the Series A, that could be hugely meaningful. And so I think a lot of our prioritization is sort of on those two polar ends of the extreme. And then I think that the magic that we've sort of been able to develop in terms of our entire team over many years is the desire and willingness to pull on a thread for a very long period of time until it leads to something interesting. And I think there's different ways to prioritize, like this sort of idea of a barbell strategy. Another is the thing we were talking about earlier, which is, okay, can we do something that somebody else can't do? Can we deliver something to the market that other people could do, but there's no business model to support it? So the original idea with the review, which is where we do all of our long form writing, that's now led by Jesse, who's the incredible editor of the review, is just this idea that the best stuff about building companies can't be shared in a paragraph. Yeah. It needs to be shared in thousands and thousands of words on any topic. But there's really not a great business model for that right now when sort of we launched it about 5 years ago. But hey, our business model is very different, so maybe we can do this and nobody else. And so there's sort of different ways to think about things in those different dimensions. But there's also just following curiosity. I think we one of the things I'm most proud of is when somebody has an idea for something, sometimes we just say, oh, that's kind of interesting. Let's see what happens. Yeah. And don't think about it too much and just sort of go do it and see what happens. And a lot of the stuff that we've done over the years starts at point A and leads somewhere like fundamentally different, but it's just sort of following the pull of something.
But we have, I think, to that point about experimentation, like the way, one of, I think, our core strengths and how we actually define where to focus is that ability to take an insight from the founder and say, I'm meeting this need in this one-off way. Yeah. Is there some experiment that I could run that would teach me whether this could scale, be productized in some way, be available to many more members of our community, or sometimes could the community deliver this to other members, to itself? Yeah. Could the community sort of self-perpetuate this idea? And if we were able to model this behavior in some way, could we then sort of scale that? And I think the Fast Track is you should talk about that, but the Fast Track program around mentorship is an awesome example, I think, of something that we saw founders doing around mentors and mentorship within companies and across companies. And then we were able to find a way to sort of bring that to a whole bunch of people. But it started with an experiment of a single person inside First Round saying, like, I think I see something here. Here's how I would set up this experiment to test this hypothesis. And then when it starts working, then we're able to lean into it.
Yeah. And I'm curious for the things that you killed, perhaps, that are maybe just too ahead of their time or too early or maybe weren't a good idea. One I'm personally curious about is founder pooling. What did you learn in that project? Why didn't that quote unquote work out? My understanding, you didn't continue it. Do you think it's ahead of its time and it will be brought back in some form? What are your thoughts on that?
Well, I think the original idea came out of this idea that VCs, one of the compelling things about a venture firm's business model is that it's highly diversified, or at least depending on the strategy, sort of fairly diversified.
Yeah, VCs are diversified, founders aren't diversified.
Right. And not only not diversified, it's just like the lack of diversification is like jaw dropping, right? You're in every hour of your life, most of your economic upside is sort of all tied to this one thing that's also phenomenally illiquid for like 8 to 12 years if you kind of build something really meaningful and big. And so wouldn't it be interesting if people could sort of take a slice of their equity and pool it all together, and then in many years you would sort of share in the upside? And so we had this idea, and this was sort of back, I think, in 2008, 9, and 10, and Josh and I were kind of tinkering on this idea. And it came out of this early idea of how do you take something that's a anti-network effects business and make it a network effects business. And so like an interesting way to do that would be to create this economic engine that you could be a part of if you were part of this thing. And so we spent a lot of time starting to work on it, and we had this idea. And so we pitched it to all of our founders at our CEO summit, I think in 2009. And people loved the idea. It like totally resonated. We had this whole presentation about, we had like these little eggs, and we showed like the power of having all these eggs in a basket together. And we sent an email around after, and all these people signed up. And so then we went to work on sort of creating the legal entity and structure and tax and sort of all the complexity that goes along with it. Kind of moved it forward. And in the process, we thought a lot about, well, what are going to be the fundamental issues? And I think the number one issue is the adverse selection problem, where you might have the founders, quote, with the most challenging prospects be most excited about being a part of this, and the companies that were on a tear would be less interested in sort of, diversifying. So we created all sorts of different ways to avoid that. Like there were only a certain number of scenarios that you could join the pool, a certain amount of time after we initially led the round, and all sorts of other things to sort of put structural things in place so that there was sort of effectively, they really couldn't be adverse selection. And so we sort of went to launch it. And what we found is that everybody loved the idea in concept. And when you actually, and everybody signed up and signed the LOI, and then when you reached out to people to transfer shares, a fraction of people wanted to do it that said they originally would. And so you start to get in that, and I think some of it is the outlier nature of building venture-backed startups. So, if you think about if you think about pooling all these assets together, you effectively are creating a synthetic venture fund. Yeah. So you start to kind of poke at that and you say, okay, that means if we do, a pretty darn good job, we're going to 3x whatever the entry price is. If we do a very good job, we're going to 5x. And we want to if we want to do truly exceptional, we want to clear kind of like just an astonishing hurdle would be sort of a 10x. And so you start to do the psychology of that, and you're like, okay, I'm putting at whatever fair market value, I forget it was at a 401A or whatever the last round, or we came up with some methodology. The value of my, 5% that I'm putting in might 5 or 10x. Versus if my company works, it's going to be 1,000x from where it is. And so there's some issue about, even if for almost everyone it would be a good investment, there's the difference between sort of whatever underlying reality or what the numbers would say and sort of the way that somebody feels. And so I think some of it is like Charlie Munger has this idea of liking the thing that you have irrationally so. And so I think some of that comes up when you kind of give people the instructions to sort of transfer shares. But we ended up spending a ton of time and a ton of capital on it. We never even launched it because we just didn't want to do something that we didn't feel like was going to be successful.
Do you think it will exist in some form soon, or do you think it's, for the reasons you mentioned, kind of
I think it's very challenging. And I think that one of the big changes you've seen in the last 5 or so years is as a company starts to work, there is a reasonable secondary market. And once a company hits escape velocity, generally they're stapling primary and secondary together. And so there are more opportunities to take 5 or 10% of your position off, which is becoming much more mainstream and sort of how the late stage markets have evolved.
And do you guys like that, by the way? Do you enable that? Do you encourage that? Are you against that? Do you have a view on?
No, I think that oftentimes some amount of secondary allows a founder to continue to take the risk inherent in building a business sort of by nature for the first time, and to continue to push and to scale. Yeah. I think when you start looking at not even so much the percentage of their ownership, I think, but just the amounts of wealth that comes off sometimes, I think it can create some perverse incentives or otherwise change the mindset of a given founder. But I think that for the most part, we're very supportive of founders doing something in the later stages where they're able to get some liquidity. And there's no reason that people should be, living with tremendous stress, and that the ups and downs of their company should flow over to the overall economic well-being of their family and so forth.
Do you think so? There's other ways to get liquidity or other ways for founders to diversify, which we'll get into scouting in a second. But do you think it would ever work with employee pooling?
I think it's challenging when you actually look at what has to happen for any of it to be meaningful. And so I think the more and more you shrink your ownership position, the more and more challenging it becomes. And I think the odd thing about sort of any time you diversify is the people that are thrilled that they did it are in the situation where the company didn't work. And the people that are very frustrated that they did it are in the one that did work. And so I think human beings are just fundamentally rational about that. And in some ways, do you want to like create this employee pooling entity that all the most, quote, successful, high impact people and employees and companies or whatever felt like this was not a good idea, and the ones that like, there's just a lot of pragmatic issues that I think make it very hard.
So the biggest one for me is one of the massive benefits that we talked about with the exchange fund was not so much diversification across a given cohort of companies, but across time. And so you'd say, okay, I'm a founder, I'm just starting, but I get a small piece of someone who's 4 years in and potentially is sort of headed towards an exit when I'm raising my Series A. And so now you start to get a little bit of time diversification in addition to spreading across multiple, equity slices from different companies. And so I think that the really hard thing about that is somebody has to start it. And it's one of those ideas that I think similar to some other businesses where you would say, once everyone does it, it's a wonderful idea. But until everyone does it, an existence proof. Exactly. And so I think the getting, and particularly to the problem of for people whose company is working, they're much less likely to want to jump in and participate. Yeah. And those tend to be the more mature companies that are successful that you need to participate in order to draw everyone else in. Yeah. And so I think you have this problem of the cold start problem with this is tremendous.
Yeah. My question, and I've been looking into like quadratic voting, quadratic finance. So maybe if, there are mechanisms by which if all people agree, it would only happen if all people agreed in the first place. But I'm just interested in the broader question of would we have more founders if it was somehow less de-risked to be a founder, if founders could approach some of the, portfolio diversification that VCs get, or no?
I don't know. I think right now in today's market, with the access to capital that we've seen and the ability for people to raise money, assuming access, which is a whole social question that we could get into, but I think where there's lots of problems. But I think that for the people who are starting companies today, access to the capital to start them and the ability to have a salary and the perception of risk, I think is on the lower end. Also, I think as there's more ups and downs and volatility in large companies, you could say, okay, if I'm a technologist, I could go work for a division of a very large tech company, or I could start a company. And in either case, you probably have 2 to 3 years of working on a certain problem before there might be changes that are outside your control. And so I actually think that while the perception of risk for starting a company broadly across the economy is pretty high, I think for people who are in the startup world or in the broader Silicon Valley technology world, I think startups' relative risk in starting a company versus working at one is not that great. And we actually see one of the challenges that we see in today's market is people believing that they can just start a company and then raising money before they've really done the work to define the company and the product and the customer. Yeah. And I think not realizing some of the risks that brings on in terms of once you raise money, kind of that you're now running at a target relative to when you decide you're going to explore an idea, you have a tremendous amount of leeway and surface area to navigate in order to figure out where is the best opportunity.
And do you do both? Do you invest in people who are, hey, I don't even know my idea yet, or I'm super early, I'm day zero, or do you typically invest in people, hey, we know where we're going, we're now searching for,
Yeah, so I think that companies have 4 stages, right? So and we do well in 2 of them. So the first is the inspiration phase where you say, I'm going to leave Google, Facebook, whatever, and I'm going to start a business, and it's going to be in, the healthcare space, right? And you're on a journey of discovery. And I actually think other than very specific angels with domain expertise, investors at that stage are usually not super helpful and probably force you to lock onto ideas before you're ready and force you to move forward when actually what you should be doing is broadening. Right? So they force you to go deeper when you should be broadening. And so that's at the inspiration phase. As you start to learn more about your market and you define your customer and you've sat with them and you understand their pain point and you understand the problem they have, the way it's currently being solved, the solution you can bring to market and how you would solve it. I think now you're in this aspiration phase where you kind of have defined your North Star and you don't know how you're going to get there. You may not even know the team that's going to help carry you there. And you probably haven't built a product that even starts you along that path, but you've done the work to identify a North Star. You understand the market, you understand the customer, and you have some sense of the value you want to deliver, and you have this aspiration. And I think that we are very, very good engaging with you there. As you work your way through the aspiration phase, you move from, at the beginning, everything you do is net new. It's not repeatable. And in the Paul Graham parlance, it's the things that don't scale, right? And as you move through the aspiration phase, you start recognizing what works and what doesn't. And you're going through that build, break, learn cycle of product creation and of company creation and of evolution as a founder and growth. And at some point, you flip over into doing more things that are repeatable and marginally improving them to make them more efficient and fewer things that are net new to the business. And you move from aspiration to operation. And now you're trying to figure out that wash, rinse, repeat cycle and make your operation as efficient as possible. So to do fewer and fewer things, but create more and more value with high leverage. And we're very good as you evolve into that operation phase. And then I think once you have wash, rinse, repeat, or you put $1 in one end, you get $1 plus X out the back. That's when you're ready for scale. And we're probably not so good at that either. So I think in the early sort of journey of discovery, my view is investors aren't super helpful. Right. I think in the aspiration and operation phase, I think we can be tremendously helpful, and you can get a lot of leverage from the community that we've built and the way we think about helping you have the context necessary to make your best decisions. And then when it comes time for scale, you have an engine that works, and you just need to pour fuel into that engine. And I think there's lots of options for that.
So you guys have built out this amazing platform, this 15-year run of great companies and great track record. I think you're the best seed firm in market right now. My question, you guys have surely debated this. I'm curious where you netted out or why you didn't pursue these paths. So one is doing Series A. Why couldn't you compete with some of the best firms out there? And the other,
well, given their recent strategies, we do.
Okay. Makes sense. Moving early. The other is why not, you already have this platform. Why not an accelerator? Where you're doing 150K for 7% and you're doing many more companies and you scale out the platform, the network effects. You guys have stayed true to what you do, but why not? Besides focus, blah, 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 which is true. But, I'm curious how you've thought about those conversations.
Yeah. I think it for the team and as we talk about as a leadership team, the way we think about the product and the customer that we're serving has over time, I think we've built an understanding of that customer. And I think that we have a very specific point of view on the products that customer needs and a way of delivering that value to them. And I think every time we look and say, should we somehow broaden that? Should we move into this gap in the market or some other opportunity? We always think the trade-off between the value of focus, as you're saying, and sort of our ability to continue to deliver the product, continue to evolve, continue to experiment, and make sure we don't become static in our core, versus the potential value in some of these other areas. That trade-off has never been worth it. And that doesn't mean that, over the long course of first round as a firm and hopefully it's a perpetual institution that at some point there might not be other ways. But so far as we've looked, there's been so much opportunity within the core seed investing landscape and even more broadly just looking at early stage and how we can engage with a founder and build wonderful partnerships with them that sort of moving into different methods of product delivery haven't been appealing.
I think a lot of it hinges on, do we think we can be exceptional at something? And I think when we talk about different directions to go, the bar is pretty high. Yeah. And I think you would see us change our strategy, widen the aperture even more, which we have a lot in terms of if you look at the range of check sizes we write, that sort of dramatically changed from 5 years, even 5 years ago.
5 years ago it was what, and now it's?
5 years ago, I'd say the average check size was under $1 million, maybe 750 or 800K, I think was on average. And now our average check size, I think, is like $1.95 million. But the range in check size is what's sort of changed most dramatically. Certainly, the average has meaningfully changed, and that's sort of companies are raising more. And I think in many ways, they're fundamentally raising more because the supply exists. And so it's supply influencing demand than it is some profound thing has changed in terms of the needs of the customer. But if you look at the range of checks, like the franchise was named for a very specific reason. First round, it's people ask us like, well, where do you invest? And so for us, we want to be the preferred partner of people that are just getting going. We want to be the best of the world at one thing. And so if you look at the range of checks, I'd say in the last year or two, we probably have written a 500 or 600K check, or probably a couple $4 or $5 million checks. And so the aperture has changed dramatically. But when we think about meaningfully changing like the customer we're serving, I think a lot of it is like, do we think we can be truly exceptional at something? And I think a lot of that comes through having a unique take or some level of invention. And so my sense is that if we were to start to do, if you see us do different things in the future, it would come out of some insight that we believe that if you look at Series A investor, where the gap is, what are the needs, there's a very specific new thing that could be provided. Or we have, some point of view on why something could be really excellent. And I think we're in search of those ideas, and we're excited about those ideas. But until we have them, we tend to kind of focus on sort of the core.
What's the thing you're watching? I just saw, or that you're closest to. I just saw that you guys did a Pakistani company. What's it called? Airbus?
Yeah, the company announced that, but we haven't announced that yet. But yeah,
the company announced it.
Yeah.
Is global an opportunity? First round somewhere else?
I think that one. So I think broadly looking at international when Brett was just talking about the check size range from 500K, which some people would call pre-seed, to $5 million, which classically was an A, and really understanding where opportunity lies. So far, it's been the willingness to break the rules that we had in place for so long as the market has evolved, and firmly recognizing that we have focus, but also recognizing that increasingly that makes us contrarian in this market by staying focused on a single, early stage, having a single fund that does that, and partnering with founders in a very specific way with a clear model that's understandable. We engage early. We want to be the first institution and the first call for those founders. We build 15, 18% ownership. We take our full pro rata in the next round, and then we get diluted alongside the founder after that. Right. And the math on that is very simple, which is we believe there'll be dilution going forward, sort of from the B and beyond, and that our goal is to own north of 10% of the business when there's an exit. And therefore, if the exit is more than $2 billion, it returns our fund and everybody's very happy. Right. And so I think that we have increasingly looked for broader range of entry points, whether that's different markets or different evolutions of early stage companies with different capital needs. So from hardware companies to software companies is very different. Someone who's going immediately into a heavy enterprise sales cycle versus somebody who's launching a consumer app. They all have very different needs. And what we didn't want to do was, because of our rules around our business model, eliminate opportunity in the market for those founders who are, while they're raising 500K or they're raising 5 million, they're in that aspiration phase of the company building, right? So they have very different capital needs, but the companies actually at the atomic level, those companies look very similar, even though one needs 500K to test an idea and one needs $5 million to build out a sales team and product such that they can test their idea.
Totally. Yeah.
And I think what's really interesting about that you've seen, I think, in a pretty pronounced way over the past couple of years is, if you look at an early stage seed round or whatever you want to call it, I think a lot of it, in terms of are they going to raise $1 million, $2 million, or $3 million, is purely based on what the market will bear. Yeah. It has nothing to do with the founder says, I need to do this to get to an inflection point or that. Sometimes that happens, but we see founders on a regular basis that'll say, I'm raising X, and by the time the round is done, they're raising 3X.
We see this sometimes in slide decks. Wow. Someone comes in to present to our partnership, and they've been scheduled to come in on a Thursday, and they were scheduled on Monday. And they come in and present, and the last slide says they're raising 2. And they'll say, actually, since this week, while I've been having these conversations, I'm now going to raise 6. Wow. And it's really being driven, as Brett was saying, by supply rather than demand. And I think one of the challenges there, and something that we tend to focus on with founders, and we have practice in it around raising Series A, but now we're seeing it more and more at the first round, is there's a third silent person in the room when you as an entrepreneur and the VC market are negotiating terms. And that third person that doesn't have a voice is the company. Yeah. And the best partnerships and the best investments are made when both the VC and the entrepreneur are operating in the best interest of the company, right, rather than the best interest of either business model on the VC side or some aspiration around, whether it's valuation or round size or risk mitigation, as you were just talking about, right? Or you raise more money, it feels like there's less risk. Actually, in many ways, there's more risk.
Right. And the implication here is that you raise too much money, it sets you up for potential failure. If you don't meet your milestones, it's harder to raise the next round, maybe down round.
I think that happens. I also think when you think about the things that make an entrepreneur really successful, we always talk about the pace of execution. But another thing we look at is the learning per dollar that they're able to generate and that ratio of learning per dollar spent. And when you raise more money, like we used to joke that regardless of the size of your Series B, it was 18 months, right? Until you had to raise again, regardless of how much you raised. But increasingly that's true at the seed. And so I think, yes, there's the chance that you raise more, therefore your valuation is higher and therefore you can't grow into it. It's much harder. But I also think part of what happens is you have bloat in your organization and you learn less per dollar spent. You spend more dollars, so you may learn just as much. But when someone looks at your operating style and cadence and your pace of execution, they're comparing that to spending $5 million versus spending $2 million. And if I, as a VC, know 5 other people who could learn just as much on $2 million, I might think that they're 2.5 times better than you. Yeah. Right. And so it creates all these totally challenges.
There's an odd thing where I think that if you were to be able to say, okay, the business to sort of execute in a scrappy, aggressive sort of way, the business needs $1.5 million to sort of prove out whatever set of experiments we want to. I think the ideal model would be raise 2x that. So raise 3 million and don't change the way you're executing. And because ultimately, like, running out of money is the existential thing that destroys all companies. We can all agree on that. The problem is, for whatever reason, almost no one is able to do that. And it's fascinating. But it's, there was the old Al Gore thing, we're going to put this money in a lockbox sort of joke.
But can they do that actually?
Companies that we partner with that raise $2 million or 200, somehow in 18 to 24 months, it's gone.
It's the same thing with us at Product Hunt. We raised like $1.2 million. We were like, man, what are we going to do with $1.2 million? And then 3 months later, $6 million. We're like, sounds about right. Just like, what are we going to do with all this money? And so I'm curious how, and Josh Koppelman from your team mentioned that, I remember you mentioned to me, like, the companies have stayed the same, but price has gone 3x bigger in the last decade. And so when do you as investors, when do you walk? When do you say, hey, I know this is 3x more than it should be, but if it's a winner, I'm going to be, celebrating regardless. So how do you think about it? When do you walk versus when do you eat it?
Yeah, so
do you have a framework for it?
It's really challenging. And I think especially in this environment, there is this sort of boil the frog phenomena of hearing about and seeing rounds coming together for companies that are increasingly early and prices that are increasingly high. And you can always rationalize the price because the ideas and the visions of great founders are always a great investment. At the time, especially at the first round, it's the multiple you're going to capture if they are successful is just unbelievable. And so I think at the same time, though, I think price does matter. Like the idea that at seed price doesn't matter, that means math doesn't matter. And an investment in Uber at a $5 million post versus a $15 million post is epic in either way, but it's 1/3 as epic. If it's at 15, that's just the reality. And so for me, the way I think about price is try to think about it in a vacuum. So inside the room at first round, founder presents, they leave, we talk about it. Without any outside influence, what's the price that we're comfortable with? Which has a lot to do with the way we think about the business and the opportunity and the risk, but doesn't involve the risk of the capital markets. It's just the customer market and the opportunity for that business. And then try to say, okay, now what insight do I have to the founder's opportunity in the capital markets? And then looking at that gap and trying ultimately to get to a place with the founder where they are comfortable with the product that they're buying for their equity. And it's probably never going to be the lowest cost way for them to raise money when they partner with us. It's just not. But we believe, and we drink a lot of first round Kool-Aid, but what we believe is what they get is also of the highest quality and therefore is worth more.
Say more about this company's more like a 5 post, this company's more like a 10 post, this company's more like a 15. Like what differentiates in your view, like the type of risk that is is your framework for how investors should think about pricing?
Yeah. So I think that there's, you can look at guesses at market size. I think that's very hard to do, particularly at the first round. It's very hard to understand the ultimate market that people will attack. I think a lot of time it really comes down to the founder and the progress that you believe they will make in the near term and the amount of control they have over those outcomes. Meaning, are there a lot of dependencies and things that have to go right? Josh calls this domino rally companies, where if A, then B, then C, then D, and then you have a big business, and where those A, B, C, and D are outside of your operational control versus things that are in your control. I think there's also a sense of the founder's understanding of customer and their sense of product. And I think also the founder's orientation around what's important in this business, and are they prioritizing the things that you also believe will be the keys to understanding if there is value here. Because the other thing to remember is most of these companies don't become epic, world-changing businesses. The thing you want to look for is someone who will open the door to learning whether or not this company can be a durable enterprise, and that if it can, they can run through that gap and create that business, right? And so I think it's less about the 5 versus 10 versus 15, because that, truthfully, I think comes down to how much dilution is a founder comfortable taking in exchange for partnering with the individual partner and the firm and the product, and to join this community. That ultimately is the decision that the founder has to make. And they are trying to understand the value that we will offer to them and how we will accelerate their business, how we will help them see the larger opportunity that's hidden behind the local maxima, et cetera. But I think that the idea that you're willing to stretch as an investor has a lot to do with the confidence you have in the opportunity, but specifically meaning the founder's ability to scratch the surface and uncover the target-rich environments, and then go and land a very large target within that.
Everything that's sort of happened with WeWork lately, there's been more about sort of, founder, company, investor. What other decisions you mentioned the third person or the invisible, sort of entity in the room. What other decisions are very important to that third entity in the room that, are important for you and the founders? You mentioned fund size, you mentioned valuation. Are there any others that come to mind that are really important to get right early on?
I think company culture is a huge one, right? And I think the type of company that you want to build, people talk a lot about that from a diversity perspective, which I think is critically important. But I also think just the way decisions are made, and is the place a place where someone is making the decision unless there's data that proves otherwise? Or is the place a best idea wins, much more egalitarian environment where the best ideas come from wherever they come from, and then that person can be the champion of that project. And I think there's a whole bunch of, are you optimizing for pace of execution and sort of the move fast and break things? Or does the market you're operating in require that actually you need to move fast, but you can't break anything? Right. And like if you're building a healthcare company, that would be an example where you need to move fast, but you can't break anything. So I think understanding the culture that you need at the business. And I think the very, very best founders often do this from the point of view of, like, at some point, if I'm successful for personal or professional reasons along the way, I will likely step away from this business. This will not be my last job. Yep. And what is the entity that I'm building, and what is the decision-making culture and the day-to-day work culture and the way we interact with customers and regulators and so forth and so on in our market? And what do I believe sets up the business, the third person in the room, for success? And today, I'm the very best person to lead that business. And as long as I am, I will do so. But I want to make decisions that are optimized around bringing out the best in that whole team, but also doing what's best for that company in the market.
Totally.
And sort of you're getting at what is the essence of the things to look for that tend to lead to sort of outsized outsized outcomes? I think, and Phin was sort of getting at some of this. I think the ability to altitude shift as a CEO is generally pretty positively correlated with outsized success. And I think that, in a lot of ways, I think humans tend to be, quite good at like high level strategy and vision, and here's what we're going. And then, or they tend to be very good at getting down to like the atomic level of what's going on in a business. But oftentimes it's more rare that somebody can zoom in and out very, very effectively. And I think we've seen that people that are able to do that tend to be fairly positively correlated, I think, with building really big outcomes. Yeah. And I think you see this they have this amazing knack to kind of zoom all the way out and tell you what's going on. Here's what we're building. Here's where all the little chess pieces are sort of out on the board. I see this very specific opportunity, this gap that we're going to go through. And here's how all these things are going to kind of play out over the next couple of years. And then you can drop down and you can say, okay, I noticed that you have sort of these 3 pricing tiers that you're starting out with. How did you land on that? And they could spend 20 minutes telling you the methodology, even if they have no pricing experience, but the level of thoughtfulness in this one little piece over here, and then go all the way back out to some sort of, a few years out, what do you think, if this works, what do you think the implications of that are? And they can sort of paint this incredible story of what's going to happen. And I think more often than not, you see somebody that's stuck at a high altitude or stuck at a low altitude. And I'm sure you see this in meeting with a lot of founders, but you could ask anything, and they can't help themselves but from getting down and confusing everything even more. And so there's a magic of these people that can go up and down and get you really excited and tell you how all what's going to happen in sort of the strategy that they're laying out, and then go all the way down to some marketing email they sent out yesterday and why that, performed or didn't perform.
But I think the reason that that's indicative of potential for greatness in a founder is not only are they able to sort of go to the front, so to speak, and see, be the feet on the street and go sit with customers, and at the same time come all the way back and think about large strategy. Yeah. But the instinct to do that and to altitude shift, as the company scales, the quality of the information coming back from the edges of the business and their ability to interpret that information is so much higher because they have the ability to actually go and do that work and be focused on these very small granular details, and then zoom all the way back out and remember how they fit into this larger puzzle. And so I think that someone who can do that at the earliest stages, they're raising their first round and thinking through how to tell the story to investors, to people that they're trying to get to partner with them, early adopters of the product, et cetera, is also someone who, as the company scales from, 2 to 10 to 1,000 people, is able to continue to visit the front and to be at the edge, and then to come back into the mothership. And then over the intervening months, as they're getting information from the field, they're able to act on it in a very different way than someone who doesn't have that ability to go back and forth.
Totally. I love that. And let's give some more examples of maybe some first round isms about company building. You guys are sitting on, 15 years of data about what great companies do and how companies struggle. You mentioned Paul Graham earlier. The Paul Grahamisms are like build, make something people want, or, do things that don't scale, or, just talk to your customers. What do you think are, that was a perfect example of one perhaps, but what's another sort of first roundism or sort of thing that you guys have uniquely picked up about company building that you've seen in your portfolio that you make sure everyone knows?
I think we talk a lot about experimentation, and it flows through the way we operate first round, but it also is something that we talk to founders about a lot. And when you think about experimentation, when you raise a venture round, you're out there to validate, de-risk, or disprove a hypothesis, and probably multiple hypotheses, right? And so finding the ways to identify those hypotheses, to understand not just, I think, minimum viable product, but something that people don't talk about enough is minimum viable failure. Like, how do you know when you've gone far enough that you've disproved something, and you do enough work to have the information that says this is disproven, right? We need to now move in a different direction. Not talking about pivoting the company, but in any little aspect of your business as you're building it.
And is there an easy framework of thinking about when you have failed enough? Or
I think what the thing that it's different. It always depends, right? Like anything. But I think that the people who are able to define success and failure for a given experiment that is time bound and specific have a much better chance of effectively identifying minimum viable failure and not falling into the trap of, if I just do this, then I'll cross over into success and I'll have minimum viable product versus minimum viable failure. And so I think when we think about hypothesis testing and experimentation, that idea of time-bound, very specific objective measures of what defines success or failure, or if there's a gray area in the middle, how do you identify that? And then what are the iterations that you're going to make on those experiments? I think that's something that we think about a lot. I think it's something, it's built into our DNA, but it comes from the founders that we serve.
Totally.
I think there's a bunch. One that we talked about recently, one of our partners, Bill, sort of hammers on this, and it's the idea of, does the founder go deep? And I think that, Phin was sort of mentioning this earlier, but I think for a certain category of founders, it's easier and easier to raise capital today in larger and larger amounts. And it used to be that the market forced you to do the work, right? So if you went back 15 years and you said, hey, I'm leaving my startup and I'm interested in this area, that nobody would give you money. Yeah. And so because of that, the market forced you to go do work, deeply understand the customer, crystallize your insight, have the ability for someone at first trying to get together and ask you some questions and really drill in on an answer that is cogent and well thought out and grounded in a fundamental insight. And most insights are born out of doing work and doing the hard work. And now I think in the market, obviously, depending on who you are in the general areas of interest, you don't have to do really any work to raise $1 million or $2 or $3 or $4 or $5 million. And so, we talk a lot about what is the work that this person has done and how deep have they gone and why do they believe this or why do they believe that? And I think that tends to be something that we spend a lot of time talking about. It doesn't mean that the business has to be validated or that there's traction. I still think a majority of the businesses that we have the opportunity to partner with tend to not have any real demonstrable data, product, whatever. But if you ask somebody why, you could sell this product at $1 million a year, you're choosing to go mid-market, so call it 200 to 300 person companies. Why? Yeah. And in that answer, you generally understand sort of how deep someone went, particularly if they haven't spent their whole career in that area. And there's a lot of conversation if you come in and listen to our partner meeting about what is the quality of work and the amount of work that's been done. And sometimes you could do it in 6 weeks. Yeah. And so I think that's something we spend a lot of time talking about and debating and discussing.
And I think it leads to the unique insights that are not typically the light bulb that goes off and, that's the answer, right? It's not that. That's not what we're looking for. I think when we talk about founders doing the work and going deep on a problem, it's about being able to structure and frame the very clear hypotheses, the data that they have gathered so far that are leading them to the conclusions that they're starting with, right? The assumptions that they're making, what underlies those assumptions. And then also the work that they will do post-financing to validate those assumptions and then build on them as a foundation for this larger vision. And I think that when you find founders who have not done that, and it's we're going to raise and then figure it out, the thing that we talk about is, so we're financing a journey of discovery around this market or around this problem. And the temptation, we were just talking about lockboxes, the temptation to identify the first, what seems like an MVP and unlock the lockbox and dump a ton of money on it is really significant, right? And so much better to have someone who understands this is the market I'm going after. This is why I'm making these assumptions. Here's what I've gathered so far. I'm objective and cognizant that I could be totally wrong, but these are the experiments I'm going to run to test these hypotheses. And I know that some of them will be right and some will be wrong. And the ones that are right, this is how I'm going to build on them. And this is where I'm going to sort of navigate my way towards that North Star. So
we have some co-investments in common. Village Global in the first round. We have Airbase. We have Ostium, Data Gravity, which you did. And a mutual friend and a company that you guys backed, we would have if we had been up by then, is Modern Fertility. And Afton remarked that you, Finn, weren't an expert in the category when you first met, and then you became an expert very quickly. And you have to do that for lots of different companies. Do you have a framework for understanding a market or getting up to speed in a market really quickly?
Yeah. So the first thing I tend to do, so first I enjoy that work. Like I think my background is consumer, and I think that to be good at consumer, one of the things you have to do is to be schizophrenic and be able to be the customer and have tons of empathy for that customer. And so anytime I meet a founder who's working in a space that I don't understand, so whether it was learning about the fertility space and generally reproductive health with Afton or other examples around synthetic biology or trying to understand crypto, et cetera. Every time, I think the very first thing I do is I try to take either a sentence that the founder has laid out in an early conversation that talks about what they're going to do and why, and as best I can, Google that sentence and just see who else is talking about that. What other companies are playing on those types of words? And are there research reports? Are there other experts? Academia is a great source. Yeah. And just try to understand the broadest possible landscape around the vision that the founder has. And so for Afton, she talked about the fundamental insight she had from, and this is someone who definitely had done the work, like Afton, if you know her, is one of the most intense women and founders I've ever met. Like, she's amazing. And she came from this space in private equity where she was working on rolling up fertility clinics. And so she deeply understood the economic model of a small piece of the healthcare landscape for women. And she started to see every time she pulled the thread how it was broken and how it didn't fit together. And what she came to, she was able to boil all this information down into a single sentence, which was basically summed up as: women don't have access to the data and information they need to make their best decisions at the time they should be making those decisions. Yeah. And in general, healthcare in the United States anyway, when it comes to reproductive health and fertility, is an infertility system, not a fertility system. And so the answer that women were getting from their doctors when they came and said they want to talk about fertility was, the first question was, but how long have you been trying to have a baby? And if the answer was, no, I'm just thinking about it. They said, oh, don't worry about it. Are you under 35? Okay, just keep going. And so she said that, and I thought that seemed crazy to me, that was actually the case. And I didn't have any personal experience, obviously, in dealing with that. And so started pulling back that thread and Googling and reading online about how people think about infertility and fertility, and then finding experts and companies, and then start making phone calls. And it turns out if you're the letters after the @ in your email address or firstround.com, people will answer your emails. And so from academics to investors on the private equity side to some CEOs of fertility clinics, and then into the medical area with some doctors who are working with women on this. And it became very, very clear first that insight was correct, that there were tests available to get this information, but those tests, standard of care did not allow those tests to be prescribed when a woman had not been trying to conceive for some period of time. And so that from that insight, then starting to learn about the economics of that model and understanding the way that care should be delivered, then going deep on the science around the dry blood spot tests that Afton was proposing, and then understanding the way she was thinking about the market. And I think whenever you do that, there's sort of this parallel thread that you're pulling. So you're doing your own independent research, and then constantly weaving that back together with the founder and what they're saying. And I think most founders that I've worked with who are able to help me navigate that learning curve, the very steep learning curve, they are able to describe very clearly the conclusions that they've made. They're also able to surface the information, data, and sources that they use to come to those conclusions. And so then I can marry sort of their data pool with mine and come to my own conclusion and see if we agree, if I think that the way they're thinking about the business is the same.
What's interesting about that is I think a lot of the conversations we have are trying to really get at what is the fundamental insight. And I think at times it's actually harder. Like, it's very easy to confuse X for Y. And I think I was reading this interview with Brian Grazer, and he was sort of this incredible career of creating blockbuster movies. And he was saying, all along my career, a lot of people think because I've had so much success that anytime I come up with an idea or I work with a director or what have you, everybody just gives me money to do all the things that I want. And he goes, still to this day, it's hard to raise money for a lot of the ideas. And he was sort of, and then sort of he was being asked, well, why is that? And he sort of got to, I think people often don't see what I see, and they misinterpret what this whole story and narrative is all about. And he said, a long time ago, I was raising money for this movie Splash, which was about a mermaid and whatever. And he said, what I noticed is why it was so hard to raise money for the movie is every time I pitched it, the executive would say, nobody cares about a movie about a fish. This doesn't make any sense. And he goes, what they didn't understand was this is a love story. reinvented and told in a different way. And I think like that's a misunderstanding about what this whole thing is all about and what the fundamental insight is. And I think when you're spending time talking to founders and hearing them tell their stories, it can be very easy to say, oh, I think this is about, making this thing cheaper or what have you. But it's actually about creating a whole new category, or there's so many things that, it's easy to think it's a story about a fish when ultimately it's really a love story or something much more profound or sort of what have you.
Yeah, no, it's a really good point. I think you were asking about superpowers before, and I think the promise to at least try to see what you see, right? Yeah. So as an investor listening to a founder's story, I will see what you see, and then walk away from that conversation and then think, in order for that vision to come true, what do I have to believe? Yeah. And now let me go and see if I can be convinced and learn those things and believe those things could be true, such that I too see what you see. Yeah. Right. And then you have a partnership.
Totally. So one thing you guys innovated on recently, which we really admire at Village, is the Angel Track. Sort of this accelerator community-like experience for angels where you bring them in and you educate them and you create community amongst them. As far as I understand, you guys don't have a scout program necessarily, or you don't plan to back micro funds. How do you view the scout micro fund ecosystem? All operators are becoming angels and your own angel track. I assume the strategy there is, hey, build relations with great angels, and now they're going to want to partner with first round and bring deals first round and give back to the ecosystem. How do you view some of these topics I'm bringing up?
Well, I think a lot of the stuff that we do are kind of grounded in a lot of and we can kind of talk about this in sort of two pieces, maybe more about how that thing came about, and then sort of adjacently maybe talk about what's going on in terms of scouts and new fund managers and sort of what have you. But I think a lot of the stuff that we do is often oriented around sort of like remixing the same set of ingredients. And a lot of the stuff that we sort of see as a through line between all the different things that we do, it really orients around like ideas, knowledge, information, and relationships in human beings. And when you look at what we're doing with network and software and what we're doing with Fast Track, which is something that Phin was mentioning, that is sort of the scaled mentorship program, you look at all these different things, they generally oriented around like information and relationships. And some of it is actually inspired by higher ed. And something we sort of, Phin and I spend a lot of time talking about is, GSB and HBS, it's a fascinating thing when you look at like, what are these institutions? And you kind of generally boil it down into, it's sort of this very small set of ingredients that's sort of packaged up, right? One is a credential. So, I went to Stanford and it means X, or it did mean X, or it means Y today, or sort of what have you. You generally have some content portion. You learn managerial accounting. You learn, you go to touchy-feely. You do sort of whatever. And then you have the sense of community. And not only did I meet new people and network or what have you, but the magic I actually think is if you look at somebody that goes to business school and you look 5 years later at their wedding, there's like 3 tables of people that would have not been a part of their life had they not sort of gone and been a part of this thing. And so they basically taken these 3 elements and kind of put them together and deliver them in a certain way that has unlocked both tremendous value for the people that have been a part of it, but certainly the institution is like unbelievable, the sort of scale that has sort of come out from those sort of 3 things. And I think a lot of the stuff that we do tends to be organized around that. And some of the Angel Track stuff started with this idea that we sort of started to think about, how do you create more opportunities for people to build new relationships in a very deep way? How do you create new opportunities for people to learn new things? And how do you create new opportunities for credentials? And in a lot of ways, like venture firms are in the credentialing business, right? Firm X invested in my business. And so long before my business has any traction, it's like, oh, this smart person, this credentialing agency said you're really smart and you're really great. And so you should join my company, even though we have no product, we have no this, we have no that. And so venture firms in essence, certainly the best venture firms are credentials. But the surface area of that credential is like phenomenally small. They invest in X number of companies in any given year. And so is there the opportunity to sort of create a credential that's not only just tied to investing in a given company? And so we started to work on this idea for a product program because we were at a salon, which are these small dinner formats that we hold in New York. And one of the people there was a VP of product at a startup that was about 300 or 400 people. And she was saying that, in New York, I feel like there aren't the APM programs and a level of investment in young product talent in New York that there is in the Bay Area. And I feel like somebody that's not at a given company should create this experience that could bring young product people together, that can share new ideas, a curriculum, and ultimately sort of accelerate their career. And so we did that for 16 product managers in New York. And it was incredibly interesting. One of the most interesting things were you started to see people that were a part of it get new opportunities through the other people in the program. And you started to see sort of on their Slack channel, people being invited to weddings or to go to this engagement party, or, you started to see some really interesting things. And so as we've been spending a lot of time thinking about what are the opportunities to educate new investors, to build new relationships, a lot of it sort of came out of those kind of sets of ingredients and kind of remixing them and repackaging them for Angel Track. And that's sort of what Phin spent a bunch of time on with Ben and others on our team.
And yeah, I think with Angel Track, the power of a group of people coming together to both learn from and offer their insight and teaching to others is just this amazing thing, particularly around something that's kind of, like viewed as some sort of dark art, like angel investing. It's unknown how you get access to the best opportunities. And, if you're someone who's typically been an advisor to your friends, how do you then ask them, well, I'd love to invest in your company, and how do you cross that line? And how do you think about an opportunity or a market that you've never looked at before? Like we were just talking about with fertility, right? How do you do that? And so I think the idea that we could bring together a group of people who have from zero to a little bit of angel investing experience and put them in the room together, get content brought into them from the very best in the angel investing, world. So we have partners from First Round will speak. We've had Elad Gil speak. We've had Keith speak. We've had #Angels speak, on and on. And I think that they're able to provide a point of view and the way they think about the landscape. But then most importantly, we give the group that's in Angel Track the opportunity to talk about what they just learned, and then also to talk about investment opportunities together. And so there's a period of time at every Angel Track where people will talk about the interesting things that they're seeing and get feedback. And when you look across the backgrounds and the experiences of all the people in the room, but then also now we're seeing crossover between cohorts of Angel Track. So now across the entire Angel Track community, it is basically 99% sure that if you want to talk to someone who has expertise around a given company you're looking at, they exist within Angel Track. And so now you have the ability to reach out to someone who works in a company that operates in a similar space, an adjacent space, or a competitive company, and ask them what they think about this opportunity that you're looking at. And then also you have people who, they've made investments, they understand what to look for in founders, they're talking through that. And you get to do this, the repetitions that you get, the value of those repetitions as a productive member of that group is so high, right? It might not be quite as good as, okay, now I'm going to write a check and the commitment and then the support afterwards. But I think the opportunity, particularly on the decision-making side and thinking through strategies to access founders as well as to support founders after investment, is something that having this group together and they can all feed off of each other and talk about things in a very open way has been really, really powerful.
Yeah. In closing, I want to ask you guys about the future of First Round. So, we've said First Round, been 15 years. I'm curious, 10 years from now, what is it possible that First Round could look like? And you guys have, there's been some generational transition. Howard, one of the founders of the firm, is no longer with the firm. The original partners are getting older. You guys aren't super spry. I'm just giving, what's your sort of unique framework for generational transition? And how do you think about, First Round 10 years from now, 15 years from now?
I think one of the core pieces to First Round and the way we operate is the team dynamic that we have. Right? So we recognize the importance of team and we recognize the importance of brand in this business. Obviously, there's a tremendous role of luck, but I think all of us as partners are relatively humble when it comes to how we happen to make a certain investment, both as a firm and as individuals. I think we recognize the value that others bring to that conversation, the way that one conversation with a partner shapes the way you think about your next meeting with an entrepreneur and makes you more or less excited. And I think that the very core of First Round is a fundamental spirit of teamwork, and recognizing that the group is much, much more powerful than sort of the sum of the parts, right? And I think that is what enables strength in whether you call it generational transition or evolution of a team, even talking about potentially entering other markets or building other products. I think all of that sort of is rooted in this idea of a model that doesn't have attribution, that you understand that you're going to contribute to the benefit of first round, and I think fundamentally the very, very long-term view of every decision that we make. And so I think one of our core advantages in the market as a venture capital firm is this long-term orientation and the willingness to invest in products and services that support founders, but also in investment areas and opportunities that will pay off over a very, very long term, and be comfortable with that as a team, and to know that we all support each other in those efforts. And I think that orientation will allow for high quality to continue regardless of the players, on the field, but also will fundamentally attract the right type of people to come in to the firm who have that same orientation, because it's a pretty specific operating model and something that I think we pride ourselves on and has been critical to our success so far.
My guests today have been Phin Barnes and Brett Berson, first round. We at Village Global have been immensely inspired by what you guys have done, and grateful that we've been able to team up and hope to do more. Thank you so much for coming on the podcast and the work that you both do.
Thanks for having us.
Thanks, Erik. It was great.
If you're an early stage entrepreneur, we'd love to hear from you. Please hit us up at villageglobal.vc/network catalyst.